Hello, everybody. Welcome back to Beer and Money. My name is Ryan Burklo, and on today's conversation, we're going to be talking about risk tolerance. I think for those of you who have invested money, you might have filled out what they call a risk tolerance questionnaire to decide in that account what type of risk, and risk meaning like how much should be going to stocks versus, say, bonds, you should take in that account. And while that's definitely something to consider, for today's conversation, we're gonna discuss what that risk really means and really how the human brain works, as well as we're going to discuss what is the balance sheet risk tolerance that you're taking and how to plan for the future. So that's for today's conversation. Without further ado, let's kind of dive into to it. You know, so often as I'm talking to other advisors and even, seeing what's on social media, I'm seeing these, what risk tolerance you should have. And it's always a risk on what portfolio you should have. And what's really interesting is risk tolerance has changed over several decades. Risk tolerance today is, as I mentioned in the intro there, how much money should be in stocks, which is higher risk, versus bonds, which is lower risk. But keep in mind, there are risks associated with bonds. And I think many people forgot about that. All you have to do is go look at 2022 and see what bonds did in that year. It wasn't pretty. And so bonds can also go up and down. Interest rates affect bonds quite a bit. And we've done an episode on bonds, but just a real quick um, review of that. As interest rates go up, bond prices go down. So there's an inverse relationship there. And then rates go down, bond prices go up. So there's a huge effect, and especially the longer term bond that you have, the bigger effect it is. But when we come back to the risk tolerance piece, there's still movement even within bonds. And so if you have if you say a 45-year-old, maybe they're comfortable with like an 80-20 allocation in their specific account. What that means is 80% of the money will be going to stocks and 20% of their money would be going to bonds. What's interesting about that is several decades ago, there was a third piece that often was talked about, and that is how much should be going to cash. So there was, now there's like a two-legged stool rather than a three-legged stool. And when you look at planning long term, like eventually you're going to want more cash on the balance sheet to minimize risk, liquidity, not have the market make or break you when you go to retire. Like an overly simplistic example of that is, let's just say 2022 was the year you were going to retire. And that was the year that the market is down. Well, if most of your money was tied in the market and stocks and bonds were both down in 2022, if most of the money was in the market, that two-legged stool fell over. So that third leg really creates that balance and the stability, and it's often overlooked. So I just wanted to bring that to your attention, and we're going to talk more about that when we get to the balance sheet part of this risk tolerance. The second piece of the risk tolerance when we talk about accounts is we all have recency bias, right? Up until 2022, like the prior decade was, if we're just talking about the S&P 500, was just, it was going up and up and up. And you can forget what it feels like until there's a down year. And so because you forget what it feels like, some take more risk than they probably should. And especially if they're not working with a professional or have someone in their life that can coach them around how the market works and when the market's going down and not get too emotional, right? And what I mean by emotional, by the way, I think many people that at least work with me, I don't think many of you, when '08 occurred, or even when 2022 occurred, if you weren't my client, you may have not gone to cash, but you may have changed how you invested in your 401k. So you made a decision based on what was going on. That's an emotional decision. And that's an issue, right? Maybe it made sense, maybe it didn't, but the fact of the matter is you should understand what the real risk you're taking. And when you're working with a good advisor, they can actually show you the academic, standard deviation, like what that risk truly is, what you're risking every year, and help you coach you through that. And kind of going back to this recency bias, again, when it's all good and gravy, we can get overconfident. And frankly, when we have a couple bad years, like if you go to 2000, 2001, 2002, that was 3 straight years of negative years in the S&P 500. It was probably hard to keep any money in the S&P 500. And if you had a lot of money in the S&P 500, that wasn't a good thing either. That's diversification. That's for a whole nother episode. But again, recency bias creeps up even to the best of us, including myself and Alex, right? So this is why it's key to make sure that you've got a professional or someone in your life to help you through that, and you truly understand the risk. So that's just the risk tolerance on the investment side of stuff. So I'm going to share my screen. I want to go over what a bigger conversation that, for whatever reason, is not spoken about all that often. And it's, what is the risk tolerance that you're actually wanting to take on your balance sheet? And I would make a strong argument that even that 45-year-old that I was just talking about in their investment account that was okay with taking an 80-20 risk, I think that might be an 80-20 risk more so for the balance sheet, not just for the account. Like, that risk is associated with, okay, if the down year occurs, so 2022 occurs, or something like that occurs, especially if you're in tech, you might start getting worried about getting laid off. Or maybe that your company's not doing well and you're not being worried about getting laid off, you might want to go to a different job. And so if you don't have enough liquidity on your balance sheet, and by liquidity, I mean access to funds that are not correlated with the stock market or doesn't affect you emotionally, then you might jump ship and go to maybe start your own business, like, right, that flexibility that we always talk about. But even bigger than that, and I already brought this up, we're planning for the end, right? Like, you're planning, like, the fact of the matter is you're building these assets for one reason, and that's to kick off an income, maybe two reasons, I apologize. The first reason is kicking off an income stream to you when you no longer want to work. That's just fact. And the second reason is probably some version of legacy. Maybe, maybe not, but those are the two main reasons that we're saving money. Okay? So those are the two things. Like, the stereotype, the standard advice out there is okay, well, let's do a risk tolerance questionnaire around your retirement account, right? And so here's your 80-20 that the risk tolerance questionnaire spit out, and hopefully you're working with a professional that's actually getting to know you so they can hold you to that. So 80-20, right? You get to retirement, or you get to, like, the year you want to retire. How have you dialed back the risk, right? So when you get to retirement, are you going to still be in that 80-20 allocation? Most people don't want to be, because they no longer want to have that same risk associated with their balance sheet, because now they're going to start turning on an income stream. Well, when you don't have your balance sheet set up and the true risk associated with that, what if there's a down year a couple years before retirement, or the first year in retirement? Like, do you really want that to have an effect on whether or not you want to stop working, or at least in the capacity that you were used to? Most people I bring this up to, they all say, yeah, that makes sense. I don't want to have that, and I'd rather control that. We can't control the market, right? As an advisor, I can help with, like, establishing what risk you want. I can help you with diversification and efficiencies and philosophy. Like, there's a lot of stuff I can help you with, but the one thing I can't control is what the market does. Nor can I predict with any kind of certainty what it's going to do, right? So when we get to retirement, wouldn't it be nice if we were, for instance, this example, let's just say this person, for example, they're making 300 grand a year. For simplicity's sake, let's just say they want 300,000 in retirement a year. That's their income. If they get to retirement and they want 300,000, what if they had most of the money sitting in some sort of an account, like their first 2 years of income, for example, so $300,000 or $600,000 of income sitting in an account that is not correlated with the market, so that even if the market goes down, they've got funds sitting there that they would pull from, rather than pulling it from the market, their money inside of the market, and it would allow it to go back up. Like, wouldn't that be nice to just pull it from one bucket of money that's not correlated, and the other bucket of money that went down because the stock market was down the year before allows it to come back up? That would be really nice. So back to my balance sheet risk tolerance, I would argue that most people, they're taking an 80-20 risk in their account, but that's probably the same risk aspect that they should be looking at from a standpoint of their balance sheet. So if we're looking at this person here, they've got $1 million between the investments and retirement accounts in the stock market and $30,000 sitting in savings. So this person is not in an 80-20 allocation currently. By the way, the 20% in savings or the 20% in that allocation, I'm not saying that has to be in bonds. Like, I'm saying that why don't we mix in some cash and some other items where, maybe we're getting a little bit higher yield on our money, so we're not getting back to 1% or 0% or having the interest rate affect us a ton. But there are other ways to put money, inclusive of bonds, that will get some sort of return and set us up from an allocation standpoint. Right. And then when we get to the 20% aspect and we're taking into consideration where we're saving money, then maybe we can actually purchase more stock, which in theory will get a higher return over long periods of time. So let's just do I built this out. I'll show you what we did here. Let's just do a real quick analysis of what I'm talking about here. Okay. So this person has $30,000 sitting in cash, right? What if we move that to a different sovereign account, a different structure where it's getting an after-tax rate of return roughly of, call it 3%, okay? And then they've got a bond account, right? This is the 20% bond. So they were saving $35,000 a year or $45,000 a year. So $9,000 was going into the stocks or the bond portion. So $9,000 a year going into bonds. I put an after-tax rate of return. So this is after taxes return of 2%, which if you look back how it's been doing, that's right about where we've been at. And I've increased this at like an inflationary rate, so 3% per year over the next 20 years. And then the last one is the stock portion, right? So of the $45,000 that they're contributing to their investment accounts, $9,000 was going to bonds if they're doing that 80-20 allocation. $36,000 is going to the stock side. I've got an after-tax rate of return of 8%, right? So after tax, okay, 8%, so that's roughly 10% rate of return. After tax is 8. Again, I don't know what it's going to do, but it, in theory, is going to get a higher return than bonds. And again, I'm also putting that at 3%. So what this person is on pace to get, just on those contributions, not including any of their other assets, you can see, now this is a fixed rate of return, right? It's a steady Yeti, the 2% on the bonds, the 3% on that cash or that other savings vehicle, and then the 8% on their stocks. So now we're looking at $2.5 million, not including of any of their other investments. Okay. So that's what they're kind of on track to do from a contribution standpoint over the next 20 years. What if they were more specific and they were trying to get more money outside of sitting in cash that were not correlated with the market? So they start to put less money into bonds, and I'm not saying to erase bonds, by the way. They're still going to put money into bonds. Matter of fact, they're going to put $5,000 of the $9,000 still going to the bond portfolio. But what if they take the $4,000 and put it into that savings vehicle that was getting the 3% after tax return? Okay. And they put that in there. And because they've got more cash and more liquidity on their balance sheet, now they can take a slightly more risk with their stocks. So now they start to add, you can see what I've done here. We've added the other $4,000 when we put it more towards the stock portfolio, again at 3%. So because they're adding more liquidity, they're still taking roughly the same amount of risk, which allows them flexibility in the down years and all that kind of fun stuff, but also allows them to put more money into the stock portfolio. So now if we start to look at this from that standpoint, once we add that, you can see it jumps. It goes from 2.5 million to 3. So again, looking at the entire balance sheet and not just focusing on an individual account allows you to take different strategies towards building wealth. And this is just a small example, an overly simplistic example, mind you, of how to do that. But this is why focusing on an individual account basis and looking at the risk tolerance there, you have to look at the entire balance sheet. What's the risk tolerance you want with your balance sheet? And how do we affect where to put money to be more efficient and still take roughly the amount of risk that you want to take? So that's my episode for today. I just kept reading risk tolerance and, people being nervous about the market and all that kind of fun stuff. And I just wanted to remind people, look, we need to look at the entire balance sheet, because if your balance sheet is set up appropriately, it becomes more flexible, it becomes more efficient, and it allows you to weather the storm even when we have that recency bias kicking in. I hope this episode was valuable. As always, check us out at beerandmoney.net. You can always go to the webpage. For those of you listening on the podcast alone, if you go to beerandmoney.net, you'll be able to go to the video and see what the visual side of what I explained on today's episode. Hope this was valuable for you. As always, cheers.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Quantified Financial Partners, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general public use. By providing this content, Park Avenue Securities, LLC is not undertaking to provide investment advice or a recommendation for any specific individual or situation, or to otherwise act in a fiduciary capacity. Please contact a financial representative for guidance and information that is specific to your individual situation. Ryan and Alex are registered representatives and financial advisors of Park Avenue Securities, LLC. OSJ 200 Market Street, Suite 1850, Portland, Oregon 97201. Phone number 503-221-1226. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Quantified Financial Partners is not an affiliate or subsidiary of Park Avenue Securities or Guardian. Ryan Burklo, CA Insurance License Number 0K24924. Alexander Collins, CA Insurance License Number 0H24806. Number 707-5263.1. Expiration September 2026.